Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a director at Galileo Capital. He is a personal finance expert. He is a chartered financial advisor. He's a very clever fella. Do you know it's a new year, Warren? And it's 2023. And I think the year is underway. We need to start thinking about... Well, we should have started thinking about it a week ago, but you and I were still both away. But the future of money and what we should be thinking about and how should we be behaving and whether or not we should be making any big adjustments to the way we think about money.
I think it's you're right. We should probably always be thinking about it, but as with everything in life, we get a little bit busy, through the year, and events overtake us, and so we've got to find a time in the year where we can just take stock of where we are and what we need to be doing in the year ahead. And I think this is a great time to do it. And my first big comment is, I'm always fascinated to see, the big publications like Bloomberg and The Economist will publish, their big kind of report for the year ahead, and it's filled with predictions about markets, economies, technology, et cetera, et cetera. And my very first point is, anything you read that relates to predictions about the stock markets or the economy, you could probably skip that section and just go read the technology stuff, which is much more exciting, and go and read about things that might change our world, but don't focus with any kind of real attention on the big predictions by the financial experts, and especially investment experts and economists. When we study these predictions by the economists, they are wrong more than half the time. In other words, a flip of a coin is going to be more accurate in what's going to happen for let's say the rand this year, or interest rates or inflation, than expert economists. And that's not having a dig at expert economists. It's just pointing out that they and all of us as humanity, we're not very good at making predictions. So why don't you stop reading that stuff and stop worrying about that stuff, and start focusing on the things you can control. And most importantly, if you can, rely on a little bit of common sense this year. That will help you a heck of a lot at the start of this year.
I think it's really important in terms of understanding that forecasts are impossible, and that you need to think very, very broadly and very differently about the way in which you invest your money. So how then do we do it, and how do we do it effectively?
So let's look at the things we know that are currently happening and what we can do about them. One is, especially globally, all of a sudden in the developed world, they have interest rates now. They have real interest rates where it actually costs them money if they've borrowed money, and they can earn interest if they have got deposits on money. And so that raises the prospect of a few things. One, that if you've got debt denominated in pounds, dollars, euros, then you need to start thinking about that debt very carefully, because it's not going to cost you, 0.05 or something like that in interest. It's probably going to be costing you 5 or 6% to service that debt. And so, if we look at South Africa, just in parallel, we already know that interest rates have been rising here for the most of the year and last year, and certainly, it's very possible that they continue to rise somewhat this year. And that means you need to focus on debt as your starting point. And I guess always in personal finance you need to focus on debt, but I think when interest rates are high, and certainly that's where we are now, you need to focus on your debt very carefully and give yourself a game plan where you can, where possible, pay down your most expensive debts. Look at your credit cards, personal loans, overdrafts, microloans if you've got them, and use the high interest rate environment to your advantage. In other words, try and get that debt out of your life as fast as possible, because you simply don't want credit card debt compounding against you at 25%. So firstly, look at that. Don't ignore it. Don't forget about it and hope that it goes away. It's not going away. It's growing bigger and bigger the more you ignore it. So that would be my first big comment. But secondly, control the things you can control. So if you were looking at replacing your car because you're worried about the service plan is coming to an end, or some maybe not real big reason for buying a car, but you were going to use that as kind of the excuse to buy a car this year, or some other big purchase. My suggestion is interest rates probably go up still for this year, and therefore delay that purchase for a year or two. It's not going to cost you anything. Most of us are working from home and work in some kind of a blend. So, really, do you really need a new car now? If you don't, delay the purchase, and any other big purchases that you're going to, use debt to incur the cost of that purchase, delay it. Just set it aside for a while. Wait for interest rates to start turning and going down again, and then look at making those big purchases. So for me, I know you'll tell me that not a lot of people have got a lot of money now, and cost of living has gone up, and I hear it, I agree, but this is personal finance where we've got to give the hard truths as well, and one of them is, don't give yourself excuses when it comes to debt. Make a plan. Make some adjustments in the way you spend and the way you incur debt. Delay the purchases, delay the gratification, and start building up your money. Take control. There's so much going on around us that we can't control, and that's one thing we can control is how we spend, and then use that gap in your expenses to that hopefully to kind of pay down the debt where you can. On the flip side, for a lot of people, and especially I think older people, they've been really in a lousy position for the last or quite a few years, because they haven't been able to kind of get a really guaranteed return on their money, and especially when in stock markets haven't been performing well, that they've really suffered with cost of living rising, no income stream from work because they're retired, and so they're in a position where earning interest is now a really viable thing to do. So for people, older people who can earn quite a lot of interest without paying tax, have a look at the RSA retail bonds. I saw today that they're paying around 10.5% at the moment for a 5-year. And that's a great rate. It's a guaranteed rate. Our beloved government is giving you a guaranteed return on your money of 10.5%. It's not to be sneezed at. Yes, there's tax, so don't put all your money in there, because then you're going to give away half of it to tax. But certainly that's a very important asset to look at. And then lastly, around global investments and interest rates, for quite some time, global bonds have been giving you the prospect of return-free risk. You would buy a global bond and you would be getting zero on your money, or potentially even paying away a bit of your money every year. And it was going to give you the prospect of massive capital risk. Well, that massive capital risk arrived last year, and global bonds had one of their worst years ever. But what that means now is that that's an asset you should be looking at if you're investing globally, and your kind of traditional 60% in shares, 40% in bonds kind of a portfolio. That's a very viable thing to start looking at again. So don't ignore global bonds in your investment assets, because I think they are going to offer very nice returns again. And not a prediction; it's just based on the rates that they're offering now. And even if interest rates do go up a bit more overseas, bonds should be part of any well-diversified portfolio, when the world is the right side up, and I think we're there now, Bruce. So yeah, I think for me those are probably the big investment themes, and stick to balanced portfolios. Don't listen to the big predictions. I think the rand's going to surprise us. It already is. I'm very surprised when we're at stage 6 load shedding that we were seeing a rand, substantially below 17 to the dollar, and that might carry on if China keeps going and emerging markets become the flavor of the year or the next decade again. And so don't be all or nothing in your investments. Don't sell out of South Africa because of load shedding. Load shedding and the economy are one thing. Our stock market is pretty much unrelated nowadays, and it might be a very good place to give you good returns over the next 5 or 10 years.
How much did the JSE give us last year, Warren?
I think it was about just over 3%, probably about nearly 4% for the year.
In dollars.
I know you've got the number, so I'm not going to guess. I don't know.
-3. And so
-3.
In global terms, if you invested in the JSE last year, you are poorer today than you were at the beginning of the year. If you'd invested in the S&P 500 this time last year, how would you have done? Better or worse than the JSE?
No, I mean, that I certainly know. I think you're probably 10% worse off. In other words, you're probably down about 13, 14%, somewhere around there.
17%.
17.
And the MSCI World Index?
Nearly 20.
You lost a third of your money last year.
Gee, okay.
Now, that's astounding. I mean, on the JSE last year, you lost 3% in dollar terms. But you did a hell of a lot better than on the S&P 500. And considerably better. Is hell bigger or smaller than considerably? Considerably better on the than the MSCI World Index. The JSE dramatically outperformed some of the world's biggest stock markets last year. And this is the great contradiction, isn't it?
And I think that's that's really one of the messages I'd love people to take from tonight is I'm sitting in my house right now and it's very dark because we're in load shedding, and I'm in that 4-hour stint hoping that my UPS is going to last for the rest of the show, and desperately worried about what our economy is going to do, and it's a valid concern all of us should have, and we should be angry and worried and concerned. Agree, but at the same time, those emotions shouldn't attach to what to your investments. Don't sell out of the JSE simply because of those factors. The JSE is massively driven by what's going on around the world, and in China is a big factor in our lives, and other emerging markets as well. And certainly, if emerging markets become the place that global investors look at for growth, coming out of very dead environments in the US and the developed world, then certainly we will our stock market, let me not say our economy, will benefit. And who knows, there might be a positive surprise from our government where they do something good and sort of right the economy in some way or another. But I just think be careful of being too pessimistic around your investments and attaching that to the JSE. That would be, I think, a really big mistake for the next 5 years.
I think you're right. And, the rally that we've seen so far this year, and goodness knows how long it lasts, but we've seen about an 8% increase this year. And for the first time in history, today, the all-share index went through 79,000. And I think it probably would have closed above 79,000 had Nurse not opened its big fat mouth and increased electricity by 18.5% on the 1st of April.
And I think we're kind of making up for lost time in one sense with the JSE, where we had the last decade, and certainly that that recovery that we're seeing now. Just to give it context, when we have these big jumps, and I know Naspers is kind of a big driver of that jump, it's making up for quite a few years of really poor growth, and so the JSE is in no way expensive simply because we've had this good start. It's got a long way to go before it becomes expensive. So if we're sitting at an index level of 85 or 90,000 by the end of this year, and I have no idea. I'm not making the prediction, but
not a forecast.
If it is,
not a forecast.
It still won't be expensive, and that's really my comment. Is it still won't be a pricey. So don't jump out if we have a good year and the JSE delivers a 20 or 30% return this year. Don't think, well, that's it's over, and I'm going to sell out everything. It could easily continue because stock markets often move in big cycles, and that's it's a key point. We're not expensive now. We should be rewarded for being patient in the JSE and a lot of emerging markets around the world.
Warren, a question from Joe this evening. My global investments were really bad last year. We know, Joe. We know. We've just talked about it. Should I change my portfolio this year to something that will grow better? Now, if you look at Joe's portfolio, let's say Joe had a third of his money in the JSE, a third in the S&P 500, and a third in the MSCI World Index. Well, he's lost a lot of money. And he's understandably going to be feeling a bit bruised, battered, and unhappy about his investments. Does he leave his money where it is, or does he chop it all up and go and put it into government bonds?
It's such an important question because I think a lot of people are in the same boat as Joe, and the impulse is to do something. Take action. When we see our investments are down, we want to do something to make them better, and it's a very human reaction. And in the world of investments, often an absolutely catastrophic mistake. If you're, and I think we're giving very nice context. If you've got a global investments and they're down 25%, well, you've just heard Bruce say that the world market was down a third. So if you're down 25%, it's terrible. It's lousy. I'm not defending the performance, but the context is everything else was down a third. So that means, if you're on your little boat and you're in the sea and the tide goes down, your ship is going to go down. Your little boat's going to go down along with every other boat around you. And jumping from one boat that's in a low tide to another boat in a low tide is going to make no difference to your life. The reality is, if you understand that your investments are down along with the rest of the world, and your investments aren't down much more, then the probability is you're in something that's just doing what the world markets are doing, and your best course of action in a situation like that is sit tight and just wait. The tide comes in. It's busy coming in now in a South African context and global emerging markets. And the longer you wait, the more chance you get a return. Chopping and changing now because there's an impulse to do something is why investors often do way worse than what the markets do, because they want to take action. They believe, by inputting effort into their investments, somehow that effort then will make the investments perform better. Unfortunately, that's a load of nonsense. With the best will in the world, me looking at the index and buying and selling the index, up and down all day long doesn't make the index go up. It's going to go up because of what world markets are doing, and chopping and changing simply creates a huge amount of cost, potentially tax, and then you're out of the market potentially when it's turning. I'm just thinking about people that have been sitting on the sidelines, not in the JSE. They've lost out on some really nice growth already at the start of this year, and they'll probably be sitting on the sidelines until the end of March, and then they're going to go, gee, the JSE is looking pretty good. It's up 20% this year. Let me jump in. Too late. You've missed it. So if you're in the markets now and you're in global portfolios and they are down, just understand, be humble enough to know that none of us actually know what's going to happen in the next 3 months or 6 months. What we can do is we can look at investments and say they're really cheap now. And if we're patient, in 5 years' time, they're going to be very rewarding. But are they going to be very rewarding next week or next month? We actually don't know. No one really knows. So just hang on and ride out your investments, Joe. I think, for me, if you hear a bit of frustration in my voice, it's because this is a pattern we as humanity repeat over and over again. When things are down, we sell. And that's not the time to sell. In fact, that's the time to be excited about buying. And if you're holding something which is down and it's down as much as everything else, please, Joe, stay invested. Don't be part of the herd that kind of runs off the cliff. Just stop, look over the edge and turn around and just wait. Things get better.
Quick thought on currency. South Africa's got lots of interesting national pastimes. One of the favorite national pastimes for anybody with a bit of money is to take your money offshore. If people want to take their money, sorry about that accent. If people want to take their money offshore, strategically, fast as you can, soon as you can, yesterday, when is the best time?
I think I feel like a broken record. I've been saying that my level for the rand to the US dollar is about 16.50. That was sounding fairly crazy sometime last year, but it's sounding more and more rational again this year, and I'm not going to change that view. And about 20 rand 50 to the pound. So whenever it's below 20 rand 50, in other words, if it was 20 rand and 2 cents to the pound, that's a good time to send money out. If the rand's at 16.01 to the dollar or 16.49 to the dollar, also a good time. But don't trade it. So in other words, if you know that you need to increase your overseas allocation because you've got no money or very little offshore, then use the rand at those levels, or when it gets better than those levels, to send money into dollars, pounds, and build up your overseas allocation. But don't be trading around something like this, because currencies do move really quickly, and that could catch you out.
Warren Ingram at Galileo Capital. First visit for the year. Thank you.